Hi, everyone. Welcome to RGP's webinar session today. I'm Janis Parthun, and joining me with my colleague here, Ellen Class. And you're here attending today on accelerating the financial close. So a little bit of background about me. I'm a finance and risk leader and a VP within RGP's consulting services team. I currently lead thought leadership on emerging issues around finance, accounting, and risk. I'm also the ESG reporting consulting services leader here as well. And then just a prior background, previously I was in another accounting firm focusing on attestation and internal audit services. And then previous to that, at the AICPA, focused on more from a standard setting and providing guidance perspective. And then a little bit about RGP. RGP is a global consulting company that serves a number of clients across various industries, and we serve approximately 3/4 of the Fortune 500. RGP enables rapid business outcomes by bringing together the right people to together create transformative change. And it's daring to work differently to deliver the future of work today. Now I'm going to pass this over to Ellen to provide introduction.
Thank you, Janis, and thank you, Nicole, for all the work and support setting this up. I'm a vice president with RGP's finance and accounting practice, specializing in finance transformation, which includes financial close optimization, our topic for today, as well as shared service center stand-up and migrations, process optimizations, and finance-related automation. I've been in accounting and finance for a little over 43 years in roles ranging from an accounts receivable clerk to the chief executive officer, the chief audit officer of a large global electronics firm, and finally the CFO of both the second largest nonprofit in San Diego County, as well as a multinational manufacturing company based out of Costa Rica. I'm a CFE, a CIA, a CRMA, as well as an IT project manager and a Six Sigma Green Belt. Primarily, I've worked in manufacturing and high-tech industries, both in the US and overseas, and I am passionate about close optimization and finance transformation.
Great, thank you, Ellen. So today, what we have today is what we'll be talking about initially, just highlights on finance transformation, and then diving deeper into optimizing the financial close. We'll also talk about, in terms of project success and change management factors in finance transformation, provide a client example and best practices, and then be able to wrap up on the session. So before we start though, I believe we have our first polling question we'd like to push out. So in terms of the first polling question, we just want to be able to understand a little bit of the audience. And so which organizational function do you currently represent? Are you from finance, internal audit, legal, audit committee member, or other? And if you want to just take a few seconds to select your options, we'll give it about a minute so that we can have a little bit background who is attending today. That'd be great. And it'll be interesting to see the results here. Well, majority of you are in finance, which I think that, is expected to some extent. But I'm also curious on the others. So regardless of that, thank you for joining us and having to participate in today's session. Okay. So finance transformation. Now, the CFOs and stakeholders are driving change across a number of processes. And as CFOs are searching for opportunities to drive change and to be able to improve productivity, process improvements involving the financial close is really a clear opportunity and remains at the forefront. And this means looking at the foundation of the activities or properly structuring how the transactions are recorded and handled, And this may include the chart of accounts for one, the backbone of the general ledger, and dictates how transactions are recorded and classified. If it's not standardized or if it's too complex, it creates variability. So for example, departments having different accounts with similar transactions, and it can create confusion and inconsistencies in reporting. Transaction codes are similar to the chart of accounts and having to dictate how transactions are recorded in the general ledger. If it's not standardized or consistently used, this leads to process variations and errors in reporting. And the reconciliation process, such as comparing general ledger balances to external resources, for example, banks or vendor statements. If it's not standardized or performed consistently, this also leads to discrepancies and errors in the reporting. And then second, automation and integration are also important elements to consider to improve productivity. With manual processes, having heavy reliance on manual processes can lead to process variability. And increase in manual entries and adjustments can also lead to increase in risk and errors and inconsistencies. And with system integration, if the accounting system is not integrated well with other systems, this can also cause delays, errors in the transactions being recorded. So the other thing I wanted to mention is the finance and talent. So the finance talent management, excuse me, and from a people and your team perspective is also a significant priority that many organizations are focusing on. And I can see opportunities here to be able to engage the talent as well. And then the other element that's not highlighted here, but we'll talk about is having strong change management and project execution practices. These are essential to have a higher probability of project success around transformation. Now, a few years back, excuse me, a few years back, APQC, an organization which conducts a number of general accounting benchmarks, asked over 2,000 organizations what is their cycle time to monthly close, as well as the number of days to conduct the annual close at the site level. And I thought this was interesting when I initially looked over the benchmark results, but then also you have to think about other factors, such as the industry that your organization is in, or the range of the annual revenue. And then the benchmark data can also provide perspective in terms of possible opportunities to consider what else other organizations are doing. But you can see here the data show, at least from a monthly result perspective, here on average is 6 days, but then from the bottom tier is 10 days, and then the top performer is at 4 days. And then in terms of from an annual process perspective, the number of days to perform the annual close at the site level, the average is at 18 days, while the bottom performers are at 35 days, and then the top performers are at 10 days here. So, you know, as you are looking at this and seeing this, what can you achieve with 2 to 6 extra days each month? And then if you look at from the annually to possibly up to 25 days at year end, I mean, that's a significant amount of time. So that is something to consider as you're thinking about being able to have time saved and other activities that you can focus on. Now, I also mentioned earlier about people and talent. And so it's important to remember the people element. And as we're talking about people and talent, and I also want to just share this research that RGP had conducted last year. And it was to gain insight into the workforce strategies. And this research involved surveying leaders over 1,000 global organizations. And the company surveyed had an average of 20 transformation efforts in play last year. And transformation referring to more so around strategic initiatives. And these ongoing transformations created the need for new skills. Excuse me. But the need for new skills can have, excuse me, can have significant impact when there are insufficient internal skills to address these initiatives. So you can see these survey results when the impact in terms of insufficient internal skills, it can create, for example, excuse me, delays in launching initiatives. You can see here 60% indicated that it actually created delays when there are insufficient skills. And over 50% indicated delays in completing the initiatives. And then over 40% indicated missing key initiative goals. So these are significant impact when there are insufficient internal skills for the initiatives, transformation initiatives that's being worked on. Now, these companies' leaders did learn in terms of having to lean on that people can collaborate effectively, regardless where they're located or who they're employed with, as long as they're experts in the field. And I was also reading up another recent study with APQC that indicated that new technologies, capabilities, skills gaps, and changing operating models are significantly driving the need to focus on the finance talent management. And as many organizations approach for retaining the finance talent includes investing in training and development, it's significant in terms of having to invest in the people and talent in terms of new skills. So with new technologies as a key driver, it's important to attract and retain people with digital skill set and continue the training and development. And in the current workforce, employees tend to gravitate towards companies embracing technology and using technology to provide insight and driving organizational improvements are motivating to them. The other aspect, just as a brief mention, is operating a distributed workforce, such as scaling the use of systems and tools across regions and countries. So I just touched upon some of these opportunities, but my colleague here, Ellen Clash, will dive deeper into how to approach optimizing the financial close and really share some amazing insights that she's going to have. So I'm going to pass this over to you, Ellen.
Thank you. I think we'll go to the next slide. Thanks for that great introduction. We'd like to go ahead and start with polling question number 2. I know people are always anxious to do that, and thank you for pushing that out. Question number 2 is, how would you rate the complexity of your company's current accounting close processes? Fairly simple and straightforward, medium or average complexity, complex, and I don't know or not applicable for your particular function. So there's no wrong answer here. I think the key is that you need to answer 3 out of 4 polling questions, and we want to make sure that you have an opportunity to do that. There is an interesting question in chat, which talks to this slightly, and that is the question from Marianne asking about our ERP systems complexities causing a longer time to complete the close. I would actually say that the ERP systems are growing to match the accounting standards, for instance, lease accounting and things like that, and that the complexities within an ERP system, assuming that it's been installed appropriately, should not impact the ability to close the financial books. That being said, very complex organizations with a lot of interrelationships in multiple countries and multiple time savings, definitely time zones does have an impact on the ability to close the books. It's much harder to manage the entire process when companies are sort of spread out all over the world, and you need to close to a standard date and time. That does definitely make it more complex and does add to the timing involved in the close. Alrighty, so it looks like most people are self-rating as medium and average complexity in terms of their accounting close processes now, as well as highly complex. And this mirrors the information that we've seen within our clients as well. The more complex the accounting close process is, the more likely it is to lead to some of those times that you've seen in Janis's earlier slide in terms of how many work days does it take to close the books, both on an annual basis as well as on a monthly or quarterly basis. Great, and hopefully everyone's had a chance to get their information in. All right, moving on to a little bit more details in terms of accounting close optimization. So it's very important from an organization when you're starting out on a project like this that you look at what are the goals and the objectives. And these need to be aligned from top to bottom within the organization, not just within the finance organization. It's easy to say that the accounting close is a finance function, but it involves upstream and downstream systems and processes. And so the whole organization needs to be dedicated to the different goals and objectives, and they need to be clearly stated. So the obvious one, the initial one, is to reduce the financial close cycle time, right? To the slides that Janis mentioned earlier, how much time are people actually spending in the close or in close related processes? And how could that time be utilized more effectively, not just on sort of grinding through the close and making sure that you have an opportunity to look at the numbers? It's important to try to reduce costs and time and effort through standardization, simplification if possible, elimination of some responsibilities or functions that actually occur now in your organization in the close. How can those be moved out, maybe before close or post close, but so that they don't become roadblocks into achieving a shorter financial close? The consolidation of numbers, again, we've talked just briefly about very complex multinational companies. Consolidation is super important. And then finally, automation, including the use of RPA and cloud-based tools and ERP systems. One thing I do want to mention is that automation is not the be-all and end-all. This is not a technology, necessarily a technology solution or set of solutions to finance close optimization. And finally, the necessity to work extensive hours. I still hear from organizations that we're working on the financial close for that when they come to us, they have employees that are working from 8 or 9 in the morning until midnight, or they have employees that are running reports at 2 in the morning, or things like that associated with the close. So that's not functional. I think people are more and more sensitive to work-life balance and work hours, especially post-COVID. So some of the objectives we want to talk about are shifting the main role of the finance function towards value-added business. To the extent that your group is processing manual journal entries or doing account reconciliations or looking at those details, that means they're not spending time at looking at deeper, more business-oriented financial analysis. The ability to have advanced analysis and enhanced analysis increases productivity and reduces cycle time. Establishing a formal close governance process. This is critical to a successful financial close. Enhancing internal controls. We, of course, don't want a shorter close to mean that we throw internal controls out the window, so to speak. It's important to continue to maintain those. And the final objective of reducing the time needed to be able to file any public reporting in the event that you're a public company, as well as internal reporting to your business partners, right? Because they can get the numbers much faster, much more real time if you're able to shorten your close processes up. There are companies that, based on the numbers that we've seen earlier, that are not getting actual numbers until workday 12 or 13 or 14. And basically your month is half over at that stage. So that information is already old at the time that it's being published. Let's go on to the next slide. Okay, defining a shorter close. One of the things that I do want to step away from is thinking that a shorter close either means a soft close or it means that things are just not going to get done. What we're looking at here in terms of optimizing your financial close is how do we do things more efficiently and effectively? How do we manage the close process from a well-defined close process, including close checklists, calendars, written procedures and processes? That might mean daily or regular huddles with your accounting staff to see if there's any obstacles or issues. Setting a materiality limit for the business, the company, and incorporating it into a written policy. So this is often controversial with accountants. Accountants are married to their journal entries, regardless of the amount. And that means in a lot of businesses, when we come to assess that, we identify there are multiple frequent journal entries that if you added them all up, are being done manually. They're taking up time. They're sort of a waste of money, frankly, because to the extent you're doing a journal entry for $15.99 or $29, especially if you're doing that manually, that doesn't have any financial impact to the company as a total. So setting these materiality limits and assessing those in light of your existing business and the impact to the financial statement is very, very important. We do recommend 2 thresholds, especially if it's a larger, more complex business, one for the business units and then potentially one for the company. Only opening up the ERP for material topside entries or to book in consolidation, right? Your close schedule should have a firm calendar about when different accounting modules or accounting related modules close, right? Inventory, fixed assets, accounts payable, accounts receivable. And ideally, those modules would not be opened again unless there is a significant material topside entry that needs to be booked either on the business unit level or on the corporate level based on the thresholds that we talked about above. It's important to have the ability to include tax entries in the close, right? Normally, the accounting close is the actual accountants and the general ledger closing, and then tax takes a look at things to see what needs to be booked in terms of deferrals or accruals. And finally, reporting, both management reporting and external reporting to stakeholders, investors, venture capital firms, or the SEC. We do recommend that companies consider alternate sets of books so that tax entries, when at the time the real-time entry is being made, recording revenue, for instance, and the tax entries associated with that, those things can be booked concurrently into the right account by setting up various different chart of accounts. You may have a local government annual reporting requirement, which is different than your company financial year, and that can also be accomplished in using alternate sets of books and records within your same ERP system. It's also important to talk about dependencies here. Most ERP systems have both upstream and downstream dependencies and interrelationships between systems, right? Including data, and we'll talk about that in a few minutes. We have some data management and governance slides coming up. It's important to understand what are the time involved in various tasks. And when we come in and do an assessment, that's one of the things we look at. Are there tasks that could be eliminated or not included in the close that still allow us to get to a shorter financial close without increasing risks or loosening internal controls? Janis? Okay, I just want to pick on one example, so to speak, of a functional area that has a big impact on the accounting close, and that is account reconciliations. There are other examples as well, but this one often is the sort of long pole in the tent. So I recommend moving account reconciliations out of the month-end close unless they are required. And some examples of required ones might be your bank accounts, that's definitely required, might be equity-related entries, as well as potentially revenue. But most reconciliations don't actually need to be done during the close, although that's the typical time that they are done. They can either be done afterwards or they can be done in the middle of the month for the prior month. We normally look at all of the accounts on the trial balance and we rank them by risk, velocity, and volume. And that allows us to assess and recommend possible timing for should this account be does this account have to be reconciled during the close, or could it be moved out to before or after the close? It's important to try to automate account reconciliations where possible. This does usually involve the use of technology. Some examples of Blackline, Trintech, OneStream, Flowcast. There are lots of different tools out there that facilitate account reconciliations. One that people are often not aware of or are not utilizing is virtually all ERP systems have an automated bank account reconciliation module or function. So that came with your ERP system. Lots of companies, for reasons I'm not really clear on, don't implement that. And that is absolutely one that can facilitate the automation of those, especially since we know that bank accounts both have to be reconciled during the close as of the last day of the month. And we know that those journal entries have to be made as part of the month-end close. Our goal is, of course, to increase hit rates, matching hit rates as far as bank account reconciliations are concerned, and to potentially automate resulting journal entries or adjustments. And finally, intercompany transactions. Those are also part of the account reconciliation process. It is great if everyone is on the same ERP system, which I know might be a wish for some, and to enable the posting of both sides of the intercompany transaction and both entities automatically. So one example of things that can be looked at as you're optimizing your financial close and a key area. There are other areas, manual journal entries, analysis, policies in place, topside consolidation entries, and automated interfaces with a number of different systems that contribute towards that. So the role of technology and system solution. I am not a big believer that optimizing the financial close is solely residing with technology and systems. That's just not the case. It's more often people's and process as opposed to technology. Standardization is very important. We've talked about if everyone is on the same ERP, one of the big advantages is your intercompany transactions can be posted automatically. Account reconciliation tools, we've briefly touched on that. Closing out the modules in the ERP system on a consistent schedule published well in advance so that everyone knows that schedule, reinforced regularly. We do recommend that only 2 periods are open at a time from the financial modules, the current period and potentially the following period, especially during the first few days of the close. It's important to have both of those available. Also, and I mentioned this a little earlier, we find that groups don't leverage the ERP systems they have. We've talked about bank reconciliations. Other things are setting up your journal entries to be auto-reversing in the system, workflow approval and notifications for journal entries which are pending approval, attaching backup to the journal entries in the ERP systems. Almost all modern ERP systems have this capability, and this can be a big process improvement to be able to do that for the approvers. And finally, enforcing the minimum thresholds on manual journal entries. Next slide. Okay, I touched on this briefly, and that is data management. So we have seen a number of clients where a lot of the financial close is taken up trying to get the data and the information into a usable format consistently. And that's definitely a delay in the accounting close, because to the extent that you're having to massage, alter, port the data from one system to another, or take a look at it because you know there are errors in the data, that just delays the financial close further. So an effective data management and data governance strategy is really important to shorten the financial close as well as make processes much smoother and more efficient. I think the old adage, which we've been hearing for years, garbage in, garbage out, is really critical to a data management philosophy or strategy. And this is an often overlooked area within companies. They've just sort of inherited data and systems without any real thought initially or during the improvements of what that data means, where it will be used, and how they can access that data and ensure that that's consistent. So this is an area I briefly wanted to touch on. It is important, in addition to a data management strategy, that groups are held accountable for their data, whether that's multiple vendors in the purchasing system that are duplicates, incorrect spelling of names and information, locking down fields so that if it's a numerical field, you don't have someone who has the ability to be able to enter an alphabetical character. So the whole data management strategy, which is encompasses and touches on all aspects of the organization, is really important to achieving a shorter financial close. And let's go on to the next slide. Thank you. This is just one potential data management operating model. There are multiple different operating models. The key is that you have one, that you've invested in what is your data management philosophy, what is the operating model, and ensuring that is consistently enforced throughout the entire organization. This will have significant benefits, both from a technology standpoint, but also from an analysis and data management standpoint, all of which are aspects of optimizing your financial close. So I'm not going to go into details on this, but I just wanted to make sure that you were aware as you're looking through the slides, which will be sent out afterwards to everyone, that you think about, does your organization have this? And is this something that it would be worthwhile to implement in your company to, again, shorten the financial close and ensure consistency of data for analysis as well as closing the books? Okay, on to the next set of slides, and Janis.
Great. Thank you, Ellen. And what I wanted to just mention, as Ellen was first showing about the data management examples, illustrations, there's also aspects of project management. You also saw there was elements of program management office, project management. So what I want to initially transition and talk about is also having to consider project success, understand the elements to make that successful when it comes to finance transformation. But before we do that, we have the next polling question. And the next polling question is, what has been the biggest change which has impacted your company's financial close? Is it regulations? Is it systems and tools? Is it staffing? Is it audit requirements? Or is it more than one of the above? And so we'll just give you a little bit of time for you to answer and pick your options. Although I am guessing that we might end up getting more of the response in E, which is, more of one of the above. So, but we'll see. Give it a minute or two. Okay, so we have the results here, and we did get quite a bit response in terms of more than one of the above. But it's also interesting, the second highest is systems and tools. And then after that is staffing. So that is also interesting insight here, hearing from the audience here. All right. So in terms of just wanting to talk about project success and project failures are a huge problem. And you can see here that it's estimated over 65% of projects fail. And there's also an estimated 70% failure rate of projects pertaining to strategic change and transformation. So that's pretty significant numbers. And as I mentioned earlier, strong project execution practices will lead to greater project success around finance transformations. And actually, RGP had conducted research on mission critical projects back in 2022 and surveyed over 400 senior executives across North America, Europe, and Asia Pac, and in our 4 global industries. And the goal of the research here was to be able to better understand the project execution practices that have led to greater project success. And so what I wanted to be able to have a chance is to highlight some of those factors as you're considering about finance transformation and having to think about financial close optimization as well. So you can see here, out of the survey, only 15% of the companies surveyed said that all of their critical projects achieved the key goals. And then 1/3 of the large companies have found more difficult to successfully execute critical projects since 2020. Now, there were some key observations and findings from the research, and so I just want to highlight here a bit, just to give you a little bit background in terms of the results of the research. And so from that, 5 key themes of findings were identified to be able to share with you. One is managing hybrid teams. So this was the #1 factor in terms of increasing difficulty of executing critical projects, and with significant increase in remote work. So for respondents with challenging projects, having to coordinate hybrid teams had made project execution significantly more difficult. But also a key strategy here is to have project leaders continuously reaching out empathetically to remote team members to create that connection and go beyond that current activity. The second was that with multiple parties involved. Project teams whose members are from multiple organizations are on the rise, and it's increasing the project difficulty. So on average, independent contractors and professionals from consulting and staffing firms makes up about 45% of project team members back in 2022. And then the other aspect is that the rise of projects involving multiple companies. So you can imagine in terms of now you see trends or opportunities where there are joint partnership agreements, having to be able to complete a production deal across multiple parties. So this is not just in terms of the internal project, this may be from a business model perspective or a business operations perspective. But a key point here is that there's no organization that will have all the required expertise. And a key strategy is having to take that into consideration. And so a key strategy would be making team members equal as possible, regardless of the home organization. And then also having to establish some conflict resolution procedures at the outset, so that essentially that can be able to have quick resolutions in terms of conflicts. Excuse me. And then the third thing is that the project manager matters. Having excellent project managers really creates that competitive advantage. And the key strategy is to be able to select project managers with strong emotional intelligence to motivate team members and to be able to resolve the conflicts. And having strong executive involvement can also be able to help on the influence and creating alignment amongst the different stakeholders. And having soft skills is also highly important to project success from an influence and alignment perspective that I mentioned, and be able to provide project leaders authority so that be able to replace team members or reset priorities when it's necessary and escalate when it's needed. Now, the fourth finding or observation essentially is having strong project leadership, which includes the ability to be able to manage hybrid and organizationally diverse teams and have great collaboration tools to help increase the project success. So with respondents with high project success, majority actually have a project management office in place. And also a key strategy in this is to be able to invest in effective collaboration tools to reduce the administrative burden on the project team, and to be able to retain the knowledge too, as well as team members roll on and roll off, and then also help on the onboarding of new members and just get that real-time transparency that's needed. The last observation I just want to point out is that there is also greater project success when more project team members are from consulting and staffing organizations in comparison to independent contractors, since consulting and staffing organizations are more quickly to be able to transition out team members as projects evolve or goals change, be able to just align with that, and then have best practices with onboarding quickly as well. Now, these are just important factors to consider as you're having to go through and think about improvement opportunities, such as the financial close optimization, and be able to support you in the process. Now I'm going to pass this over to Ellen, who wants to talk about change management.
So change management is critical to the success of any finance transformation project, including optimizing your financial close. Janis mentioned the statistic a little earlier that 60% of projects fail, major initiatives, and this is the inverse. This is the solution to that, is that of implementing effective change management can increase the probability of your transformation success factor by 6 times. So it's really significant. Excuse me, again, this is based on benchmarking from over 4,000 global companies over the past 10 years. I know change management is usually an afterthought for finance transformation projects or optimizing your financial close, but there are so many aspects of it. The ultimate thing is that to shorten your financial close, you have to bring the people with you, because they're the people who are performing the processes, who need to adopt the new policies, who might have new ways of working. And change management is the key to ensuring that those people are brought along with you in a successful project, such as optimizing your close. There are many intangible and often overlooked aspects of change management, including the famous resistance to change. In general, accountants are more conservative, maybe a little bit more resistant to change, to process improvements, to implementing things like thresholds and materiality limits. Most people's concern about optimizing the close is related to an acronym called WIFM. What's in it for me? People are frankly worried that they're going to lose their job, or that these changes, they won't be able to understand the technology because they are so used to their existing processes, their existing workarounds, their existing documentation, that they will not be able to embrace the new change and understand how it relates to what they need to do in order to get their job done. So super important aspect of change management. Top-level management philosophy is also very critical. This needs to be viewed as something that the whole organization is embracing, of understanding it might mean change for them as well. Hopefully change such as getting out your financial numbers earlier. Change management is critical. I think it's helpful even in a project such as optimizing your close to start with small changes and then work towards larger changes. And the single most important factor in change management is communication, communication, communication. Janis, will you take us to the next slide? And that is, coincidentally enough, also the single most critical factor for project management. Most successful project managers spend a lot of time, up to 90% of their time, communicating with others. So if you have harmonization between change management and project management, that will lead you to a more successful project by significant factors, and make sure that those changes are embedded, adopted, that people understand what the expectations are, and that you're actually able to shorten days off your close by implementing both successful change management and successful project management, delivering on the value, whether that's a return on investment for systems or actually taking days out of the close and making sure that the work is done appropriately, ensuring that internal controls continue to exist and that any risks that you discover are mitigated. So very important aspects of the close and of achieving a shorter close. Janis, the next slide. Okay. Polling question number 4. So this is the 4th of 4. If you've answered 3 of them, you could potentially not answer this, but it is important that you get this in. What is the timing to begin the close optimization process at your organization or company? Within the next few months, 3 to 6 months, 6 to 12 months out, I wish, and other. So very consistent. This is really spread across all of the different buckets as you're answering your question here. You have about another 20 seconds or so to answer. I want to make sure everyone gets their answers in. We see that this is rising, especially recently with the accounting changes to whether it's revenue recognition or lease accounting or CECL. We see that there's definitely an increase in a push towards close optimization. This is also super important for companies that are going public, where they will suddenly have to meet government reporting requirements as well. So lots of considerations. 31% in the next 3 months, 15% in 3 to 6 months, 22% in 6 to 12 months. 10% of people wish that their company would embark on a close optimization project, and finally 22% for the other. Thank you. Great information. Really appreciate that. Okay, I'm going to talk specifically about a client example about what can be achieved by all of the things that we've been discussing over all of the last slides. So this is a client in the automotive EV industry. It went public just a couple of years ago, $350 million in global net sales. Specialized electric vehicles and component manufacturing. So they manufactured everything from stem to stern, including drivetrain, battery packs, and the actual EVs themselves. And they have manufacturing in several locations around the United States. It's a very long lead time project in terms of manufacturing. So their previous financial close had been 14 working days, and we were able to help them reduce their close to between 6 and 8 days, depending upon it was the end of the month or the end of the quarter or the end of the year. So 3 main sort of obstacles or areas of concern where with regards to people, there had been a long-time controller working for the client, and this controller was opposed to system integrations. They did just not believe that systems should be integrated. They were also especially fond of Excel workbooks and spreadsheets, including some incredibly complex things. So things that we often see, for instance, not integrating your payroll provider and the journal entries into your ERP, that had not occurred at this client. They were very, very concerned about all integrations into their ERP. Unfortunately, in their first close after they went public, they missed the SEC reporting deadline because their close was so lengthy and there were so many things they needed to look at. The documentation for processes just did not exist, or it wasn't current. And finally, for their ERP system, well, they had a modern ERP system. 2 things had happened. One, they hadn't implemented all of the modules that they had already purchased or owned. Bank account reconciliations is a good example of that. And again, they were not on the latest update. So they had not patched their system since it had actually rolled out a couple of years prior. It was not a cloud-based system, so it wasn't automatically being upgraded. It was an on-prem system, but significant impact if you're not current in your technology for all the latest innovations and process improvements. All right, moving on to the next slide. Okay, so there were, in addition to the actual shortened close cycle, which is almost half of the work days involved in the close, there were a lot of other positive outcomes and benefits. There were fewer work hours and days for team members and managers. This was the company that someone was up at 2 in the morning running reports because they couldn't find another time to do it, and they used a lot of batch processes as opposed to real-time processes in their ERP system. We were able to spread the work out throughout the month, leading to a better work-life balance. We took a look at reducing risk versus higher volume of activities and transactions out of the close, allowing more time for review. There was a big focus on what is material and what matters to the company versus immaterial, low-value work that had no actual financial impact. We reduced manual journal entries significantly, and we also spread out some journal entries that did not need to occur in the close, for instance, accruals or estimates that actually could be done immediately prior to the close. And finally, we had the company focus on exception management during the financial close, as opposed to a focus on routine tasks and micromanaging those tasks for their employees, trusting that their employees would get things done, and really only having the controller and the CFO look at what were the exceptions and what were the things that needed to be addressed in that specific close. All right, next slide. All right, this is just a general slide that speaks to all of the different aspects of financial close optimization. We've touched on many of these today. There's process management, there's workflow management, data integration and your data management strategy and your ability to be able to access data, cloud platforms if possible, RPA and IPA, as well as a couple of different technologies. This covers all sorts of and all of the accounting processes that you normally think of, or the functions that you think of during your close cycle, whether that's procure to pay or R to R or billings or cash applications, and also the external reporting aspect of this, in addition to the internal business management aspect of the reporting and the tax books. All right, on to the next slide. And you.
Great. Well, thank you, Ellen, for sharing the client success story and just providing your in-depth knowledge on the financial close optimization to the session here. Now, in the office of the CFO, there are responsibilities and expectations that typically associate with managing costs and profitability and having to gain efficiency. And we discussed primarily around the process optimization. But there are other responsibilities that are not discussed here today, such as having to manage risk and compliance demands. Here you can see on the left, to transaction-specific support on the right. So today's CFOs must focus on broader opportunities and challenges that's resembled here in this illustration. So I just want to highlight this illustration here, that RGP can support your organization to address these needs around various initiatives with our capabilities and our in-depth consulting team, whether from process optimization to transactional needs or internal audits. We're here to help your organization be able to provide you the solutions and the expertise. Now, with that, and I believe we have a few minutes remaining, so and we're right on time here. So, Ellen, I want to be able to ask you kind of this last question as we're wrapping up, in terms of talking about the financial close optimization, and based on your experiences at clients, how long does it typically take in terms of a typical close optimization project may take?
So for our clients, it's normally two phases. One of them is the assessment phase. What is our current state? What is the client doing? That often takes between 5 and 6 weeks to get a good assessment and understanding of what the environment is and what are the activities around their close. And then there is the implementation phase. So assuming that we don't have any big systems to implement, and we're talking process optimization, policies, documentation, and changing the ways of working within your existing ERP systems, that is usually between 10 and 12 weeks. So that's roughly a total of sort of 15 to 21 weeks for the entire project, from stem to stern, to shorten your close, in some cases by days or even 5 working days.
Great, thank you for sharing that. So with that, this does conclude our webinar for today, and thank you, Ellen, for joining me on this session and just providing your insights and knowledge in this, and be able to share that with the attendees here. So thank you for your time today. Hope you enjoyed your sessions. If you have any questions, please feel free to contact me, or we have our contact information in the slides, and this will be available to you, should be approximately a week after today. So thank you for your time.
Thank you.